There's a pattern in market crashes that repeats every single time. And right now, in early 2025, that pattern is playing out exactly as it did in 1929, in 2000, and in 2008. Three stocks dominate the market: Nvidia, Apple, and Tesla. Together, they represent over $8 trillion in market capitalization. That's larger than the entire economy of Germany, more than Japan. These three companies account for nearly 20% of the S&P 500's total value, and they're all gonna crash simultaneously. Not next week, not next month, but in 2026. And the collapse won't be 20% or 30%. It'll be 70% or more, wiping out trillions in wealth, destroying retirement accounts, triggering a recession that makes 2008 look manageable. This isn't prediction, this is pattern recognition, because every characteristic that preceded the 1929 crash, the 2000 dot-com bubble, and the 2008 financial crisis is present right now. Extreme concentration in a few stocks, insane valuations disconnected from fundamentals, retail investors pouring money in at the peak, and institutional investors quietly positioning for the exit. Let me show you exactly why Nvidia, Apple, and Tesla will collapse together, why the crash is already locked in, and why 2026 is when the math stops working and reality catches up. The setup: extreme market concentration. In a healthy market, gains are distributed across many companies: technology, healthcare, energy, manufacturing, finance, diversified growth, broad-based prosperity. That's not what we have. We have three stocks carrying the entire market. In 2023, Nvidia's stock rose 239%. In 2024, another 171%. Apple hit a $3.5 trillion market cap. Tesla, despite producing fewer cars than legacy automakers, is valued higher than Toyota, Volkswagen, and Ford combined. And here's the critical number. In 2024, these three stocks accounted for over 50% of the S&P 500's gains. Remove Nvidia, Apple, and Tesla from the index, and the S&P 500 was essentially flat. This is stage one of every market crash: extreme concentration. When a tiny number of stocks carry the entire market, when everyone is piling into the same names, when diversification disappears, the system becomes fragile. Let me show you the historical precedent. In 1929, the market was dominated by railroad stocks and utility companies. RCA, the tech stock of its era, rose 500% in 18 months. Everyone owned it. Everyone believed the growth would continue forever. In September 1929, RCA peaked at $114. By 1932, it was $2.50, a 98% collapse. In 2000, the market was dominated by tech stocks: Cisco, Microsoft, Intel, Oracle. The Nasdaq rose 85% in 1999 alone. Everyone believed the internet would generate infinite growth. March 2000, the Nasdaq peaked at 5,048. By October 2002, it was 1,114, a 78% collapse. In 2008, the market was dominated by financial stocks: Citigroup, Bank of America, AIG, Lehman Brothers. Everyone believed real estate prices would rise forever. October 2007, the S&P 500 peaked at 1,565. By March 2009, it was 676, a 57% collapse. Every time, the pattern is the same. A few stocks dominate. Valuations detach from reality. Retail investors pile in at the peak, and then the crash wipes out years of gains in months. We're in that exact setup right now. Nvidia, Apple, and Tesla are the new RCA, the new Cisco, the new Citigroup, and the concentration is even more extreme than previous bubbles. The valuations, disconnected from reality. Let's talk about what these companies are actually worth versus what the market is pricing them at, because the gap is insane. Nvidia, market cap $3.2 trillion, revenue $60 billion. That's a price to sales ratio of 53. For context, a normal tech company trades at 5 to 10 times sales. Nvidia's profit margins are extraordinary, 55% net margins, because they have a monopoly on AI chips. But here's the problem: monopolies don't last. Competition is coming. AMD is gaining ground. Chinese companies are developing alternatives. And Nvidia's customers, Microsoft, Google, Amazon, are designing their own chips to avoid dependence. When the monopoly breaks, margins compress. And when margins compress, a 53 times sales multiple becomes insane. Apple, market cap $3.5 trillion, revenue $383 billion, price to sales ratio of 9. That seems reasonable until you realize Apple's growth has stalled. iPhone sales are flat. The Chinese market is collapsing. Huawei is taking market share. Apple's services revenue is growing, but not fast enough to justify a $3.5 trillion valuation. Apple trades at 35 times earnings for a company growing at 2 to 5% annually. That's not a growth stock multiple. That's a bubble multiple. Tesla. Market cap, $1.3 trillion. Revenue, $97 billion. Price to sales ratio of 13. Tesla produced 1.8 million vehicles in 2023. Toyota produced 10.3 million. Yet Tesla is valued higher than Toyota. Why? Because the market is pricing Tesla as a tech company, not a car company. But Tesla's margins are compressing. Competition from BYD in China, from legacy automakers in Europe and America. The EV market is slowing, growth is decelerating, and Tesla trades at 110 times earnings for a company that's growing at 10 to 15% annually. These valuations are not sustainable. They require perfect execution, eternal growth, and no competition, and none of those things exist in reality. The trigger, why 2026? So why 2026? Why not now? Why not 2027? Because there are 3 specific catalysts converging in 2026 that will trigger the simultaneous collapse. Catalyst 1, AI spending, cliff. The entire Nvidia bull case is built on AI infrastructure spending. Microsoft, Google, Amazon, Meta, they're spending $200 billion annually on data centers, chips, and AI development. But here's the problem. AI spending is front-loaded. You build the infrastructure first, then you try to monetize it, and the monetization isn't working yet. Microsoft's AI features in Office 365 aren't generating significant revenue. Google's AI search is cannibalizing their ad revenue. Meta's AI investments haven't translated to profit growth. By late 2025 and into 2026, these companies will face pressure from shareholders. Why are you spending $50 billion per year on AI if it's not generating returns? The spending will slow, and when it slows, Nvidia's revenue growth stops. And when growth stops, a 53 times sales multiple collapses. This is exactly what happened in 2000. Telecom companies spent hundreds of billions laying fiber optic cable for the internet boom. Then they realized they'd overbuilt, spending stopped, equipment makers like Cisco and Lucent collapsed. The AI infrastructure build is following the same pattern. Massive overinvestment, overcapacity, and an inevitable spending cliff. Catalyst 2, Apple's China problem. Apple generates 20% of its revenue from China. That's $75 billion annually, and it's collapsing. Chinese consumers are switching to Huawei. The Chinese government is banning iPhones from government offices. Nationalism is driving preference for domestic brands. Apple's China revenue declined 8% in 2024. That decline is accelerating. By 2026, Apple could lose 30 to 40% of its China revenue. That's $20 to $30 billion in lost sales. When Apple reports a quarter with collapsing China revenue, when guidance gets slashed, the stock will drop 20% in a day. And that will be the trigger that breaks market confidence. Catalyst 3, Tesla's margin compression. Tesla's gross margins have fallen from 30% in 2022 to 18% in 2024. Why? Price cuts to compete with cheaper EVs from China. Elon Musk has cut prices 6 times in 2 years. The Model 3 started at $47,000. Now it's $38,000. Revenue per vehicle is declining, and costs aren't falling fast enough to compensate. By 2026, Tesla will face a choice. Keep cutting prices and destroy margins, or maintain prices and lose volume. Either way, profits decline. And when Tesla reports declining profits, a 110 times PE ratio collapses. The stock falls 50% in weeks. These 3 triggers, AI spending, cliff, Apple's China collapse, Tesla's margin compression, they're all converging in 2026. And when one breaks, they'll all break together. The mechanism, why they fall together. Here's what people don't understand about market crashes. They don't happen because fundamentals slowly deteriorate. They happen because psychology breaks. Nvidia, Apple, and Tesla are held by the same investors, passive index funds, ETFs, retail traders, institutional hedge funds. Everyone owns all 3. When one breaks, when Nvidia drops 20% in a week because Microsoft cuts AI spending, the panic spreads. Portfolio managers look at their holdings. They see Nvidia down 20%. 15%, Apple down 10%, Tesla down 15%, and they panic. They don't analyze fundamentals. They don't calculate fair value. They sell all of it simultaneously. This is the mechanism. Correlated holdings, algorithmic trading, stop loss triggers, margin calls. It cascades. Let me show you how it played out in 2000. March 10th, 2000, the Nasdaq peaked. A few tech stocks started declining. Nothing dramatic, just 5 to 10% pullbacks. But those pullbacks triggered margin calls. Retail investors who'd bought on margin had to sell to cover. That selling pushed prices lower, which triggered more margin calls, which triggered more selling. Within 3 weeks, the Nasdaq was down 25%. Within 2 years, down 78%. And the biggest losers were the stocks everyone owned. Cisco fell 89%. Intel fell 80%. Oracle fell 72%. The same mechanism will play out with Nvidia, Apple, and Tesla. They're the most widely held stocks. They're in every index, every ETF, every portfolio. When one breaks, the selling cascades. And because they're so concentrated, because they represent 20% of the S&P 500, their decline drags the entire market down. The warning signs, they're already here. The crash isn't speculation. The warning signs are already visible if you know what to look for. And so warning contain insider selling. Corporate insiders, the executives and board members who know the companies best, are selling aggressively. Nvidia CEO Jensen Huang has sold $700 million in stock in the past year, not exercising options and holding, selling outright. Apple executives have sold $500 million. Tesla insiders have sold over $1 billion. When insiders sell, they're not moving to cash because they're diversifying. They're selling because they know the valuation is unsustainable. Warning, sign 2, retail euphoria. Retail investors are piling into these stocks at record levels. Call option volume on Nvidia reached all-time highs in late 2024. Reddit forums are filled with people buying Tesla on margin. Apple is the most widely held stock among retail investors. This is classic top behavior. When amateurs are buying in euphoria, professionals are distributing to them. Warning sign 3, declining fundamentals. Nvidia's revenue growth is decelerating from 206% in quarter 2, 2023 to 94% in quarter 4, 2024. Still high, but the rate of change is slowing. Apple's iPhone sales are flat to negative. Tesla's delivery growth is slowing. The fundamentals are deteriorating while the stock prices remain elevated. Warning sign 4, valuation extremes. The Buffett indicator, total stock market capitalization divided by GDP, is at 200%, the highest level in history. Higher than 2000, higher than 2008. The Shiller PE ratio, which averages earnings over 10 years, is at 35. The historical average is 17. The only times it's been higher were 1929 and 2000. Both preceded crashes of 50% plus. The warning signs are flashing red. The setup is complete, and the catalysts are converging in 2026. The historical pattern, it always plays out the same way. Let me walk you through the exact sequence of how bubbles burst, because it's the same every time. Stage 1, euphoria. Everyone believes the growth will continue forever. In 1929, they believed railroads and electricity would grow infinitely. In 2000, they believed the internet would generate infinite profits. In 2008, they believed housing prices would rise forever. Right now, they believe AI will transform every industry, and Nvidia will dominate forever. They believe Apple will keep growing despite market saturation. They believe Tesla will maintain its valuation despite competition. This is euphoria, and euphoria is always the top. Stage 2, the crack. Something breaks. A company misses earnings. A competitor emerges. A regulatory change. It doesn't have to be big, just enough to crack the narrative. In 1929, the Bank of England raised interest rates, small change, but it signaled the credit expansion was ending. In 2000, the Fed raised rates. The tech companies started missing earnings. The narrative cracked. In 2008, Bear Stearns collapsed. It was just one investment bank, but it revealed the fragility of the entire system. In 2026, the crack will be one of the 3 catalysts. Microsoft cutting AI spending, Apple reporting China revenue collapse, Tesla reporting margin compression. One will break first, and the narrative will crack. Stage 3, the initial decline. After the crack, there's a 10 to 20% decline. Not a crash yet, just a correction. The bulls call it a buying opportunity. The fundamentals haven't changed. This is just temporary, but the decline continues, slowly at first, then faster. Stage 4, the panic. This is when the real crash happens. Margin calls trigger forced selling. Algorithms detect momentum and accelerate the decline. Retail investors panic and sell. Professionals rush for the exits simultaneously. The decline that took 3 months in stage 3 happens in 3 days in stage 4. In 1929, the market lost 23% in 2 days, October 28th and 29th. In 2000, the Nasdaq lost 25% in 3 weeks. In 2008, the S&P 500 lost 20% in 2 weeks in October. The crash is always fast, always violent, always catches people off guard, even though the warning signs were obvious in retrospect. Stage 5, the aftermath. After the crash, there's a long grinding decline, dead cat bounces, false recoveries. But the ultimate bottom is 50 to 80% below the peak. In 1929, the market didn't bottom until 1932, 3 years of decline. In 2000, the Nasdaq didn't bottom until October 2002, 2.5 years. In 2008, the S&P 500 bottomed in March 2009, 17 months. The aftermath is always longer than people expect because the fundamentals have to catch down to reality, and that takes time. The specific scenario, how it unfolds in 2026. Let me paint the specific scenario for how this plays out. Q2 2025. Nvidia reports solid earnings. Growth is still strong. Apple is stable. Tesla is managing. The market continues higher. The bulls are in control. Q3 2025. Cracks appear. Microsoft mentions in an earnings call that AI infrastructure spending will be reassessed in 2026. The stock dips 5%. Nvidia falls 8%, but it recovers within a week. Just noise. Q4 2025. Apple's holiday quarter is weak. China sales down 12%. The stock falls 10%. Analysts lower price targets. But the bulls say it's priced in. 2026. Tesla reports Q2 2025 earnings. Gross margins are 16%, down from 18%. Guidance is lowered. The stock drops 15% in a day. This is the crack. February 2026. Nvidia reports earnings. Revenue growth is 45%, down from 94% the previous year. Still growth, but the deceleration is dramatic. The stock drops 20%. This triggers panic. March 2026. Microsoft announces a 30% reduction in AI infrastructure spending for 2026. Nvidia's forward guidance collapses. The stock falls another 25% in 3 days. Apple and Tesla fall in sympathy, down 15% and 20%. April-May 2026. The cascade accelerates. Margin calls, forced selling, ETF rebalancing. The S&P 500 is down 25%. Nvidia is down 60% from peak. Apple down 45%. Tesla down 55%. June 2026. Capitulation. Retail investors panic sell. Hedge funds liquidate. The bottom. Nvidia is down 72%. Apple down 68%. Tesla down 75%. That's the scenario. And it's not fantasy, it's pattern recognition. This is how bubbles always burst. Why it spreads a 70% crash in 3 stocks might seem contained, but it's not. Because the concentration is so extreme, the contagion spreads to the entire market. Nvidia, Apple, and Tesla represent 20% of the S&P 500. When they fall 70%, that's a 14% decline to the index from just 3 stocks. But the psychology spreads. If the 3 strongest stocks can fall 70%, what about everything else? Banks get hit because they've lent to tech companies. REITs get hit because commercial real estate is connected to tech employment. Consumer stocks get hit because wealth destruction reduces spending. The correlation goes to 1. Everything falls together. In 2000, the Nasdaq fell 78%, but the S&P 500 fell 49%. The contagion spread from tech to everything. In 2008, financials fell 80%, but the S&P 500 fell 57%. The contagion spread from banks to the entire economy. In 2026, when Nvidia, Apple, and Tesla fall 70%, the S&P 500 will fall 45 to 50%. Not because every company's fundamentals collapsed, because fear is contagious. What do you do? So what do you do with this information? How do you protect yourself? Option 1, sell now. Get out of Nvidia, Apple, and Tesla. Lock in gains, move to cash, wait for the crash, buy back at 70% lower prices. The risk is you might be early. The stocks could go higher before they crash, but being early is better than being trapped. Option 2, hedge. Buy put options on these stocks, or buy inverse ETFs that profit from declines. You don't have to sell your positions. Just hedge them. The cost is the premium. But if the crash happens, the hedge protects you. Option 3, diversify. If you're overweight in these 3 stocks, diversify. International stocks, commodities, bonds, real estate. Spread the risk. You won't capture the upside if I'm wrong, but you won't get destroyed if I'm right. Option 4, do nothing. Hold and ride it out, accept that a 50 to 70% drawdown is coming, but believe that over 20 years, the market always recovers. This works if you have time. If you're 25 and won't touch the money for 30 years, you can ride out any crash. But if you're 55 and planning to retire in 2027, a 50% crash destroys your plans. The choice depends on your time horizon, risk tolerance, and conviction. But ignoring the warning signs is not a strategy. In 1929, everyone believed the market would go up forever. In 2000, everyone believed tech stocks were invincible. In 2008, everyone believed housing was safe. In 2025, everyone believes Nvidia, Apple, and Tesla will keep growing. They're wrong. The pattern is the same. Extreme concentration, insane valuations, retail euphoria, insider selling, deteriorating fundamentals. The warning signs are all here. The catalysts are converging. AI spending cliff, Apple's China collapse, Tesla's margin compression. One will break first, the others will follow. And the cascade will wipe out 70% of their value. Not because the companies are worthless, because the valuations are absurd. And markets always revert to reality eventually. 2026 is when the math stops working. When the growth assumptions break, when the concentration becomes catastrophic. 3 stocks, $8 trillion in market cap, and it's all gonna collapse simultaneously. Not because I want it to, because history says it has to. The pattern doesn't lie. The setup is complete and the clock is ticking. When the crash comes, when Nvidia is down 70%, when Apple is down 68%, when Tesla is down 75%, remember this, you were warned. The question isn't whether it'll happen. The question is whether you'll be prepared.